A storm is brewing over the world's second-largest economy, one so powerful that it threatens to shake the foundations of China's growth model. In just the past month, cracks have deepened across its industrial core, consumer market, housing sector, and even its cutting-edge AI ambitions. Factories are slowing, shoppers are retreating, investment is drying up, and now China's AI dream has been thrown off balance by a crisis in its chip strategy. All this while a property meltdown drags on into its fourth year, swallowing developers whole. What's unfolding is more than just another economic slowdown. It's the convergence of structural weaknesses that Beijing may not be able to paper over this time. Today, we're taking a deep dive into the multiple crises converging on China and what it means for all of us. Let's start with the engine room of the Chinese economy, its industrial sector. The latest data out of China paints a troubling picture. Official numbers from the National Bureau of Statistics reveal that in July, industry output covering factories, mines, and major manufacturing hubs grew only 5.7% year-on-year. Now that's not just a slowdown from June's 6.8% growth, it's the weakest pace since November of last year. But it's not just the factories that are hitting the brakes. The Chinese consumer, once seen as the next great driver of growth, is pulling back. Retail sales are telling a similar story. Instead of accelerating into the summer shopping season, consumer spending grew just 3.7% compared to a year earlier, the lowest reading so far in 2025. June had already been weak at 4.8%, but July's figure confirms that households are tightening their belts despite government efforts to spur consumption. Even long-term investments are losing steam. Fixed asset investment, which covers massive projects like infrastructure and factories, slowed to a mere 1.6% growth in the first 7 months of the year. The biggest drag? You guessed it, the real estate sector, which is enduring its steepest contraction in more than 5 years. And here's the alarming part. These numbers are from official sources. This means the real situation could be far worse than what is being reported. If this is the managed data, the actual slowdown might be sharper than Beijing is willing to admit. This is happening despite an enormous surge in debt issuance as Beijing rolls out stimulus programs. Trillions of yuan have been pumped into the economy, but the hoped-for rebound simply isn't materializing. The urban unemployment rate has even inched up to 5.2%, surpassing forecasts. Some analysts are blunt about it. China's structural weaknesses are now so entrenched that short-term spending injections aren't enough to reverse them. Shiman Li, a senior macro strategist in Singapore, noted that the loss of momentum in both supply and demand means policymakers may need to make a mid-year shift in fiscal strategy. To make matters worse, July's slump was compounded by severe weather. Heat waves, heavy rainfall, and flooding added stress to what is already a traditionally softer production period. But one number shocked economists more than most. New loans denominated in yuan contracted for the first time in 2 decades. This suggests not only weak demand, but also a profound lack of confidence in future prospects. One of the few relatively stable areas has been exports. Shipments abroad have held up overall, even as exports to the United States decline due to higher tariffs. Beijing is actively trying to pivot the economy toward domestic consumption to reduce its reliance on foreign markets. We're seeing policies like subsidizing interest payments on certain consumer loans, lowering preschool fees, and expanding childcare subsidies. Yet, the fact that exports remain the bright spot is, in itself, troubling. Global demand is increasingly unpredictable, trade tensions are intensifying, and relying on external markets could prove dangerous if geopolitical rifts deepen. But the warning signs don't end with consumer and industrial data. What of China's most ambitious tech players, an AI champion meant to challenge the West, just hit a wall? And the reason goes straight to the heart of Beijing's tech self-sufficiency strategy. DeepSeek, one of China's rising artificial intelligence companies, has postponed the release of its much-anticipated R2 model. The problem? Persistent technical challenges while trying to train the AI on Huawei's Ascend processors instead of the NVIDIA systems that dominate the global market. Authorities had encouraged DeepSeek to shift toward Huawei hardware as part of the national push to break free from US chip technology. The company had already released its R1 model in January, but the R2 upgrade has been plagued with issues: unstable performance, slower inter-chip connectivity, and software limitations. The consequences were costly. Instead of launching in May as planned, the delay has set the company back in China's ultra-competitive AI race. Founder Li Keqiang has reportedly been dissatisfied with the progress and demanded more development time to preserve competitiveness. Even with Huawei engineers embedded at DeepSeek's offices, the team couldn't complete a successful training run on the Ascend hardware. Ultimately, the company reverted to NVIDIA chips for training, though it continues working with Huawei for inference tasks, the stage where a trained model is used to generate outputs. This setback exposes a deeper vulnerability. Washington has been tightening export restrictions on NVIDIA's most advanced AI chips to China, aiming to slow Beijing's progress in frontier technologies. In turn, Beijing has told major tech firms to justify purchases of NVIDIA's H20 processors and to favor domestic alternatives like Huawei's Ascend. Industry insiders admit that Chinese chips still trail behind NVIDIA's in critical performance metrics. While some experts say these are just growing pains, every delay allows US and other global competitors to pull further ahead. For now, NVIDIA retains a firm grip on high-end AI training. The company even struck a deal with Washington, allowing it to resume H20 sales to China on the condition that part of the revenue flows to the US government. NVIDIA has warned that cutting off entire markets would only harm American economic and national security, underscoring just how interconnected the global tech ecosystem remains. But if AI is the future, real estate is still the backbone of China's present, and that backbone is showing signs of irreversible damage. July brought no relief to China's housing market. New home prices in 70 major cities fell at the fastest pace in 9 months, down 0.31% from June. Resale home prices slid 0.55%, slightly better than June's drop, but still pointing to sustained weakness. This downturn has dragged on for over 4 years, and sales have fallen further since the second quarter. In a drastic move to stabilize the market, authorities are now preparing to mobilize state-owned companies to buy up unsold properties from distressed developers. Yet, Fitch Ratings warns that any recovery is fragile, hinging on broader economic health, job creation, and household income growth, all of which are struggling. Economists are already warning of a looming demand cliff in the second half of the year as overcapacity cuts, weaker exports, and persistent housing problems converge. Even China's top-tier cities are no longer immune. All for Beijing, Shanghai, Shenzhen, and Guangzhou saw existing home values fall at least 0.9% month-on-month. Lower-tier cities fared marginally better due to more aggressive local easing measures, but the broader trend is still downward. Real estate investment has plunged 12% in the first 7 months of 2024, marking the steepest drop since the pandemic. Global banks are split on the outlook. HSBC foresees a selective recovery benefiting state-backed developers in prime markets, while UBS has pushed back its recovery forecast after renewed sales slowdowns. Some high-profile failures highlight the severity of the crisis. Hong Kong's High Court recently ordered the liquidation of China's South City holdings, and China Evergrande Group, once the poster child of China's property boom, announced it would be delisted in Hong Kong. These collapses aren't just financial events. They are psychological shocks for millions of Chinese households, many of whom have long viewed real estate as the safest store of wealth. The message from the past month is clear. China is not facing isolated problems. It's confronting multiple crises hitting simultaneously. Manufacturing is slowing. Consumers are cautious. Investments are drying up. AI ambitions are stalled. And real estate is sinking further. What happens next could reshape not just China's future, but the trajectory of the global economy. If Beijing's policy tools fail to reignite growth, the ripple effects will be felt in every corner of the world. From commodity exporters to multinational manufacturers, from global banks to tech giants. The storm isn't just brewing. For many in China, and for those who depend on its economic might, the storm has already arrived. The question now is whether the foundations of its economic model are strong enough to withstand the deluge, or if we are about to witness a fundamental reshaping of the global economic order. What are your thoughts on China's economic future? Let us know in the comments below. And if you found this analysis helpful, be sure to like this video and subscribe to our channel for more deep dives into the global economy. Thanks for watching.